Hello, good morning and good afternoon, everyone, wherever you're listening to us from. Welcome to our latest European Structured Finance webinar. In these webinars, we pick one topic related to a European securitization market and update our listeners on the DBRS Morningstar credit views and findings. This week, we are discussing the non-performing loan securitization transactions with a particular focus on Italian deals. My name is Mudasar Chaudhry, and I head up the European Structured Finance research efforts at DBRS Morningstar here in London. Today, I'm joined by Christian Aufsatz, who is the head of European Structured Finance at DBRS Morningstar. We are going to divide our time in a presentation, which will be followed by a Q&A session. Questions need to be asked in writing by typing into your computer. We will answer these questions at the end of the presentation, but you can ask questions at any time during this webinar. So without further ado, let's swiftly move to the main presentation. Today, we will walk the audience through European non-performing loan securitization issuance volumes to date, a brief overview of DBRS Morningstar's methodology for rating NPL transactions. Then we will move on to discuss how we conduct the surveillance of these rated deals. Thereafter, we will discuss rating migration of Italian NPL transactions to date, their observed versus expected performance factors, and finally, we will discuss some recent rating actions taken by DBRS Morningstar in little more detail. With that, I hand over to Christian.
Thank you very much, Mudasar, and welcome everybody. Good morning and good afternoon. Yes, the idea for this webinar was really driven by some quite substantial rating actions we have taken since the summer, and really to explain the rationale behind that, the performance of the effective transactions, and really to provide some insight into what we look at when we surveil non-performing loan securitizations, in particular Italian ones. So without further delay, just to set the scene, since 2016, there has been sizable issuance of non-performing loan securitizations in Europe. This chart shows the publicly rated note balance, not gross book values, but really what was issued and publicly rated. And comes as no surprise, it's pretty much dominated by Italy following the introduction of the GACS scheme, but it has been getting more diverse in terms of jurisdictions over the years. And what stands out or has been standing out are Irish deals, Spanish deals, Portuguese deals, but it's really the Italian ones we want to focus on. And just to note that in Greece, there's the HAPS scheme, but those transactions are not included in the graph due to the lack of public ratings. So I think in order to understand the recent rating migrations, it's good to recap what does our European NPL rating methodology do, what does it look like. And pretty much in a nutshell, it's the portfolio analysis and then the transaction cash flow analysis. And when we start with the portfolio analysis, we still think that it is the servicer or special servicer who's closest to portfolio, or in Irish NPL, the sponsor. So we look very closely at the servicer's net recovery expectations at the outset, analyze how the servicer has come to those conclusions in order to determine our what we call base case net recovery expectations. So that is our expectations without any rating stress. And this can be the same as the servicer's recovery expectations. It can be lower. It's really following analysis of the business plan. And then in the next step, we would apply rating-dependent stresses, which for secured portfolios are market value decline rates, stresses on recovery timings, On the unsecured side, it's a haircut to unsecured recoveries based on historical data and based on the volatility. But the result of this portfolio analysis is ultimately DBRS Morningstar rating dependent cash flow vector, like cumulative recoveries we expect in a given rating scenario. And then when we turn towards the transaction cash flow analysis, we basically check based on the transaction structure, what is the rating scenario the rated bond still passes. So for BBB bonds, it would need to pass the BBB rating stress, which is the BBB cash flow vector. Important on the NPL side is that cash flows can be very volatile. So one special consideration is also the analysis of available liquidity in case there is periodic cash flow volatility. While it didn't happen last year, but that obviously was very much in focus at the outset of the coronavirus pandemic, where in Italy courts were closed and cash flows really dried out. Turning to the ongoing surveillance. So what do we do after a deal has been rated? And we're looking at how a non-performing loan transaction performs. I think, as in any other securitization, it is important, A, to look at the past. So how was the performance to date? What have been the actual collections on a cumulative basis versus the initial expectations, the servicers, ours? And then in non-performing loans, another metric to closely look at is the profitability of collections. So it's really the amount, what is coming in as a total, and for closed files, fully worked out loans or borrowers, has this been below or above the specific expectation? So these are the two core matrices to look at how a transaction is performing, looking in the back mirror. We also look at the evolution of portfolio characteristics, and obviously has this changed? But then there comes also the forward-looking angle. And also in surveillance, our view is that the servicer, maybe even over time more and more, understands the portfolio best. And in Italian NPLs, but also in other jurisdictions, the servicer business plans are updated over time on an annual basis in the most optimal case. So we have access to that information and can actually see how do the servicer's expectations evolve. And as we will see later on, that is very important. So looking at this more external past and expectation information, we then in surveillance potentially reassess our own base case and then also our rating stress scenarios. And that follows the bottom-up analysis, the same as at issuance. We look at the portfolio, the business plan, the most updated, and bottom-up assess our base case expectation and the stress scenarios. And then lastly, there's an updated cash flow analysis, including the transaction structure, and we have here in brackets the triggers. In one of the case studies later on, we will see the triggers are important and in relation to how effective they are. Now looking at what has happened since European non-performing loans were issued after the great financial crisis since 2016. The table shows the cumulative rating transition of all 29 Italian non-performing loan deals which we are rating. That are 43 bonds, seniors and junior bonds. And it's important, it's a cumulative rating actions, so that the initial rating versus the current rating. What we observe is that overall the rating trend is negative. The two main factors, one is the pandemic. Non-performing loans was one of the most affected asset classes from the lockdowns. But also what we need to keep reminding ourselves, there have been transactions which had already been underperforming before the pandemic. So that are the two big trends. We have to date not yet seen an Italian non-performing loan securitization upgrade, but not all is bad. Some are relatively close. So they're also well-performing transactions. But what we want to focus on today are the transactions which stand out with substantial downgrades. And we would call this a downgrade from initially BBB category towards single B or triple C is quite substantial. And the four transactions we want to discuss, or three of those we want to discuss in more detail today, are the ones on the right, which were downgraded either last year or throughout 2021 into the triple C category. So let's benchmark these four transactions based on certain performance matrices. And when we start with the backward looking, which is the cumulative collection ratio, that is how much has the servicer since outset of the transaction collected versus its initial expectations. And here we see on the left side that in Italy as a whole, that is all 29 transactions we are rating. It's not the full market. As a whole, the servicers are expecting less than they thought they would collect over time, hinting towards that it takes longer than expected. We see that the four transactions we focus on are the worst performers with that metrics, with Popolare Bari 2017 and Aragon collecting just shy of 50% of what actually the expectation and issuance was. But also the other Popolare Bari and MAJES stand out, so they're really in the lowest quantile on that metrics. And if we look though at the other metric, which is the profitability ratio, which is if a loan has been worked out or borrower has been completely worked out, how much did I collect compared to what I expected? The good news is that for Italian NPLs, which we rate, that is on average still positive, which means the aggregate effect for the market is, yes, it's lower than expected, but on average, recovery is actually higher than initially expected. So that's generally just implying, okay, it's currently market-wide more a delay of recoveries than anything else. However, the four deals again are at the lower range of these performance metrics, and three of them are still just above 100 or just below 100%, so in line with expectations, whereas one transaction, Popolare Bari 17, stands out also with having a profitability ratio, which I think the latest number is 85%, which means also now after closing files, recovering 15% less on those which had been expected. So we noted that generally there is a trend towards profitability going down currently in Italian NPLs. To some extent, that can be driven by there are now more loan sales, which might be done by servicers in order to speed up the amount coming in, which might, however, hurt profitability. Now, looking at the more forward-looking expectations, which is on the left, we compare what do servicers think nowadays of the portfolio versus what they thought initially. And here, just important disclaimer, what we are measuring here is the total expectations over the life of the deal. So that is basically looking at what has been collected so far, plus what does the servicer now expect to collect in the future, adding all that up and comparing that with initial expectations. And here we see that also not really surprisingly, servicers have revised the expectations overall downwards. Whereas though these four transactions stand out with outsized downward revisions, once again, Popolare Bari 2017 overall downward revision of 20%. And what we'll also see later on, this shows nominal cumulative gross collection expectations. It doesn't say anything yet about timing revisions. So if you expect now to collect, say, 10% less, it also matters whether you expect the collections to occur earlier or later than what initially thought. And the combined effect is what drives our analysis. On the right-hand side is a pretty simple metrics, which is, if I look at what the servicer expects for the future, how much of that is the Class A balance? So, and on average, just looking at the gross expectations of the servicers, the senior note in Italian NPLs is 60% of that. So you basically, if you expect to collect 100, senior note is 60, so you have some buffer in there still for less, first of all, for interest payments, senior cost payments, but also maybe for recovering less than what you would expect. Again, the 4 deals stand out there more at the higher range of that, where what the servicer now expects to collect from now onwards is actually not significantly above the Class A note balance anymore. And if that ratio reaches the 80, 85, or 100, the Class A note repayment becomes increasingly unlikely, because from those expected collections, you also have to pay the senior cost, the interest on the notes, and other items. And in Italian NPLs, one very important senior cost not to forget is the GACS fees, which also increase over time. So yet again, the 4 deals stand out as being at the weaker part of the market. So, and looking at how do these transactions actually perform against our expectations, as mentioned before, we would have a BBB stressed cash flow vector where we benchmark actual performance against. And right now, across the deals we rate, actual performance, despite underperforming the services expectations, is still 50% above our initial stressed rating vector. Because, yeah, obviously with the stressed vector. Again, especially the 2017 popular OBARI, Aragon, and MAJES, they are actually now already on an actual performance since issuance, performing below our initial respective BBB rating stress scenario. So they're already backward looking below our stress scenarios. So, and then putting also the future into that equation, we look at actual performance to date plus what the service is expecting to come still. How does that relate to our total BBB stress vector initially? And we see that the 4 deals, because of the business plan revisions and adding the actual performance to date, actually expectation is that, yeah, they are now, the expectation of the services is now more or less in line with our initial BBB rating stress. And that statement in itself means, okay, do we have to revise our rating stress? So that's just benchmarking these 4 deals with significant rating action against the full market. And maybe now turning towards some more details for 3 of these transactions, starting with MAJES, which we recently downgraded from BBB low to CCC high. That actually stands out compared to the other downgrades. That is very, very significant and happened in one go. Because last year we were still able to confirm the rating, and yeah, maybe I can give some background into all that. So how did the deal perform to date? Actually, when you look at the chart, the left line, that is the cumulative collection ratio. It was in the 90s until 2019. So you could still, against the Italian average, that is a stable performance. But since then, we have seen a very sharp decline, likely due to COVID-19. So the collection ratio declined from 92 in end 19 to currently 58%. There are always two things to that equation. One is what was collected, but also what was expected in that time period. And we can see that the initial business plan actually foresaw quite an uptick in recoveries exactly in 2020. So that the decline of the ratio is not only because actual recoveries went down, but also there was an uptick expected. So it was wrong on, or went the wrong direction on both sides. However, we noticed that actual collections are still on a declining trend, but profitability is still close to 100%. So, but the actual collection still on declining trend is a little bit worrying, because the base assumption was, okay, 2020, there will be lower collections, but then it will recover. But here we have not been seeing that yet. At transaction level, the Class B interest subordination trigger is breached since January 2021. So that means that currently the Class B doesn't get any interest, which helps the Class A. Looking at the expectations of the servicer, and I think that's where, where it becomes very interesting. So we looked at the past expectations, and actually until 2020, servicer here had stable expectations. So that are the blue line, the yellow line, and the red line. So the business plan revisions, while trending a little bit downwards, there was no substantial shift. What happened in 2021 was a pretty significant downward revision, so that now the expectation for total gross collections over the life of the deal is 13% lower than initially. And very importantly, what also happened in 2020 is that the timing of the recoveries has been revised, or the expectations thereof. So the weighted average life of collections went from 3.5 years to 4.5 years. So, and that's a double effect. So one is less is now expected over a longer period of time, and which means the way securitizations work is you have now for a longer period of time also to pay senior costs and interest, which is reducing the ability of collections to repay the principal of the Class A and or B, C notes. We also noted, and that's the blue line, the light blue line, that the servicer is already performing or collecting less than expected in the last revision of the business plan, which we hope is only a temporary phenomenon, but it's already indicating, okay, maybe there will be more, and if only timing revisions to come. Class A balance is now 85.5% of the total expected collections. But we know that the slower collections, and we assume that the servicer works towards its timing expectations, that the slower collection can result in underhedging. Usually the cap agreements are on a declining notional, so that it's not positive if one assumes increasing interest rates. And slower collections, as mentioned already a couple of times, repeating myself, result in more senior costs, including the GACS fees, which are ratcheting up over time. So it means also on the transaction cash flow side, this is not positive. Very similar story with Popolare Bari 2016, actually the first Italian NPL deal which we rated in 2016. Here actually what happens, the transaction performed pretty well initially. In 2016 and 17, the gross collection ratio was way above 100, so it was collecting faster than expected. And again, we have seen deterioration since mid-2019, which was then just accelerated by COVID. And again, similar to MAJES, the actual collections are still here on a declining trend. Profitability remains close to 100. That is positive, and the interest subordination trigger has been breached relatively early, already in June 2020. So this deal we took 2 rating actions since mid 2021. At the end of 2020, it was downgraded to BB. But then 1 year later, looking at the updated information we received over the year, there was another substantial downgrade to CCC. Here, the evolution of servicers' expectations were more gradual than MAJES, so that would also explain why the rating actions were more gradual. So we witnessed the downward revision of expectations in 2019. 2020 was actually stable, but then another revision in 2021 updates, so that the total is now 17% lower than the initial expectations. As for MAJES, there was a significant revision of the recovery timing. So the weighted average life of collections went from 4.7 years to 5.2. And also here, we already see an underperformance versus the updated expectations. Ratio class A versus the future collection is quite similar to MAJES. And again, we might see under-hedging and for certainly see more cash outflows in terms of costs and interest payments. So that were the 2 more recent downgrades. And I wanted to also highlight the downgrade we already took in June 2021 of Popular OBARI 2017, because here the story is slightly different. One is that that transaction has actually underperformed already since issuance, whereas other deals start relatively strong, but then it tapers off, which ultimately is expected in non-performing loans. But here the underperformance was visible day one. We actually saw some recovery of this underperformance in 2019 when the collection ratio went up to 90%. Bringing it closer in line with other deals. But then we saw a significant deterioration already towards the end of 2019, but then throughout 2020. Similar to MAJES, it's not only that the collections got less, but it's also that the expectations initially for exactly that time period were relatively high, resulting in now the lowest cumulative collection ratio of just 46%. This deal, OBARI 2017, also stands out in terms of profitability, which is declining. It was at 95% in April 2021 and has declined to just below 90% in 2021, in October. And we also feel that compared with other deals, the interest, Class B interest deferral trigger or subordination trigger are, it's different and potentially a little bit weaker because it's only based on the profitability ratio, which means as long as the profitability ratio was still above 90%, the junior notes were actually still receiving interest. But that has changed now as of the October IPD with a profitability ratio just below 90%. That deal also stands out that it is the first Italian non-performing loan securitization since 2016, which had a cash reserve fund draw, i.e. cash on the October IPD, part of that fund reserve was drawn, so it's currently not fully funded, to pay senior costs and or interest, which means Class A didn't get any principal on the last interest payment date. So that's the performance to date. And as mentioned, we had downgraded it to CCC low in June 2021. In terms of business plan revisions, that's a relatively seasoned deal. So what is interesting here is that most of the downward revision in terms of cumulative collections already happened last year. So in the 2021 update, this doesn't foresee any further decline in expectations, but yet again, the timing has changed. So we have a weighted average life increase of 1 year based on expected collections. again, having the same effect as for the other deals. And also, again, we see here that the underperformance versus the updated expectations is actually continuing. Class A balance is just below future gross collections, which ultimately means in order for Class A to repay, from now onwards, the servicer has to significantly outperform its expectations. So that's just to explain the commonalities between the transactions which were affected by these downgrades, and also to explain our thinking around that. There are commonalities in those, and they're certainly, in terms of relative ranking, the lowest performance transactions. Just to not be too negative, just an example of a transaction which we recently confirmed and also revised the rating trend from negative to stable, that's Juno 1. That transaction actually, we initially it was a very strong outperformance in relation to cumulative gross recoveries. The outperformance is diminishing, but that is not fully unexpected. In 2020, there was actually underperformance versus the revised expectations, which were done before the pandemic, but then was underperforming. But the deal is also still, it has a high profitability, also on a declining trend, but a very well profitability. So the business plan here, or service expectations, was the first update was for slightly lower cumulative collections, but at a faster pace, reflecting that they were faster than expected. Then came the pandemic, and now the second update foresees actually a little bit higher collections than the first update, but at a slower pace. Here, as mentioned, we confirmed the rating, we changed the trend from negative to stable, and are closely monitoring how sustainable this positive performance trend is and remains. But just to set, to contrast, it's very, very deal specific ultimately, what is happening there on the ground. So while the total rating trend for Italian non-performing loans is certainly not positive, there's a strong tiering between the different transactions. So in conclusion, what I just said, Italian deals are as a whole underperforming initial expectations, but as a whole, again, it's still pointing toward it's slower than expected and not yet at the stage of that it will be less overall than expected, but there's a very strong tiering between different transactions. Overall profitability level in Italian NPL is positive, but there are first signs that it might turn negative in some transactions, and OBARI 2017 being the first one, or one of the first examples. When transaction parties adjust their expectations, i.e. the servicer, it's not only important to look at the amount expected, but also at the timing expectations, because that has a considerable impact on transaction cash flows due to higher senior costs which have to be paid and longer GACS fees. You can have under hedging. So, and then we have seen that some transactions, the future recovery expectations of the servicer themselves does not exceed the Class A note balance meaningfully anymore. And then the generally, no surprise, but the credit impact of collection underperformance is greater the less optimal deferral triggers for junior payments are. So, yeah, that concludes my presentation. I hope it was insightful into our thinking about what we look at when surveilling non-performing loan securitizations with a focus on Italy. And thanks everybody for listening. A reminder, if you have questions, you can type them under the presentation into the text box, and we will then try to answer them. Mudasar, thank you very much.
Thank you very much, Christian, for a very interesting presentation and taking us through the full cycle of NPL rating analysis. On the presentation, the last slide is most recent publications regarding the NPLs. We have a discussion research published on evolving business plans in Italian NPL transactions, along with the most recent one where the evolution of European banks, NPLs and NPL securitization amid COVID-19 and impact of moratoria on NPL performance as well. I do not see any questions yet. So if there are any questions which you would like to follow up on, please feel free to send us an email. All the details are available on our website, dbrsmorningstar.com, along with all the research which we have cited here in our presentation and methodologies. And at the end, I take the opportunity to thank you for audience for listening to us, and thank you, Christian, for giving us your time.